Welcome back. You're watching Traders Corner, and joining me as always is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, so let's talk about the S&P 500 as we do every week. Last week we were talking about a bit of a wobble, and that followed what happened to the tech stocks on the preceding Friday. But everything seems to have picked itself up and back to the races.
Yes, that's right. The pullbacks here seem to be very, very shallow still on the S&P 500 at the moment. So as we've mentioned in previous weeks, the fact that the market broke above this 2400 resistance area is quite significant, and it's maintaining that level and continues to climb beyond there. Last week on the show I did say that I was a bit worried about some negative divergence that was beginning to appear on the RSI at the top there, but that seems to have been negated for now. We've had a strong session in the US last night, and now it appears that the S&P 500 is trying to knock on this 2450 sort of area. We got a big gap up last night on the open, and that gap hasn't been filled, so that could possibly be an early warning sign that we may be starting to get into a bit of a blow-off type of move here before some corrective activity begins. But other than that, I can't really say that there's anything wrong with this chart. It's still quite constructive. It's still got an overall bullish setup, rising highs and rising lows, when you can't deny that. So it's a good-looking setup for now, but whether I'd be chasing it at these levels, I probably wouldn't be.
I mean, clearly with hindsight, it would have been great to go long the S&P 500 at the start of the year and just leave it there.
Yep, it would have been a great trade, and it has been one of the strongest performing markets in the world so far this year.
So if the S&P 500 is strong and has picked itself back up and looks as if it's going to continue heading higher, what has been happening to the VIX? Because we have spoken about it in a few shows recently.
Yeah.
It's been very, very subdued. Is it then natural to see a subdued VIX with an S&P or an overall market that's trending higher? Yeah,
it is quite natural to see that. The VIX is the Chicago Board Options Exchange Volatility Index, and what it is effectively is an index that tracks the implied volatility on S&P 500 options. And implied volatility is one of the important factors in pricing up options. So if you've got low volatility like we have now, then the expectation is that there's not going to be much movement in the near term, and that makes options pricing cheaper. The flip side of that is if volatility is high, then it means that you're expecting big movement, and then it also means the potential for S&P 500 options to hit out the money strike levels becomes great. I mean, I know this probably sounds like I'm speaking Greek at the moment, but basically it talks about volatility. If volatility is low, options are cheap. If volatility is high, options are more expensive. We sit at the moment in a situation where the volatility is incredibly low, and it's been like this for a long time. We've been saying for months on end that volatility is really, really low. But now we've got a situation here which is quite interesting. The VIX futures, which expire, they settle on the 21st of June, tomorrow. As things stand at the moment, unless we get some dramatic overnight event, it looks as if we're going to see the lowest ever settlement for a VIX future. Lowest ever, not in just my lifetime, ever. Which is quite a significant thing, and it does talk to the fact that the markets are very calm at the moment, very complacent. There's nothing to worry about. But historically, when it's been like that and we've had extended periods of really low volatility, it does sometimes precede a sudden spike in volatility. Now, I'm not saying that that's necessarily going to happen right now, but I do think it warrants a healthy dose of caution, especially as we approach the third quarter of the year. Just a bit wary.
And maybe we could do a show actually on how to trade the VIX, because it is fairly complicated. It's not as simple as just buying an ETF or a share, and maybe it is something worth looking at in the light of now is the time to buy it, so maybe buy it.
Yes, that's true, but I have investigated it quite thoroughly, and the one problem with VIX is that you always end up trading it via some sort of a product that is linked to VIX futures. So there are ETFs that link towards a VIX future, and the trouble with that is that your time decay on VIX futures is very, very aggressive. So whenever I've investigated, and I have looked at it thoroughly, I've thought I'd love to just sit on a long volatility position, because at some stage this volatility will spike. I just don't know when that's going to be. But the trouble is that you end up paying away a hell of a lot of money in time decay in all of these VIX-related products. So it's not as simple as just buying and holding and forgetting about it.
Okay, well, thanks for the schooling there. Garth, what about a local trade that you've got, which is an option which is quite I suppose, a relatively inexpensive option, and the trading around that, which you explained to us last week?
Yes, that's right. Well, we look at the top 40 futures chart, which is shown here, and then it's got the option structure payoff on the right-hand side over here. So, I talked about this head and shoulders structure on the top 40 a few weeks ago, and that the market looked like it might come lower. It's come a hell of a lot lower. It's actually, we had 12 down days in a row on the top 40 futures up until yesterday was the first up day. 12 down days in a row. I've never seen that in my lifetime, and I looked back in my charts to go back as far as I could. Even in the crash in 2008, we didn't see 12 down days in a row. So it's quite remarkable, and I don't know whether that's ever happened, but if it did ever happen, it was beyond where my charts go back to. So it's quite an interesting thing that we've seen such a significant move lower, and it's almost kind of happened without the feeling of much panic, really. Anyway, what I did last week was I went long slightly against our option structure, because we do have a put spread option structure in place on the top 40, which we discussed on a show a few weeks back. Last week I said that I was going to buy a very small position against those options, knowing that the downside is protected, and I went long of 2 all-me futures. And at that stage it was the June all-me at 45,415. Now, obviously we had the June futures close out last Thursday, and now we've moved on to the September futures contract. So what I had to do is roll over that exposure from the June contract into the September contract. The September contract trades around about 400 points higher than the June contract, and that is because of time value, effectively interest, that's made up over the next 3 months, and then dividends that are discounted back into the futures contract. So it works out that your September futures contract trades about 400 points higher than the June contract. So we've gone into the into the September future at 45,820. So we're effectively long 2 all-me futures from that level. And the payoff structure on the right-hand side, you can see illustrated there. We're right sort of close to our maximum profit zone as things stand, but remember, this structure runs all the way out to September. I can't bank those profits yet.
But you could bank potentially the all-me contracts that you've taken out.
Yes, I could. But in fact, that all-me is, funnily enough, it's actually slightly underwater at the moment. But if the market rallies a bit more from these levels, yes, I could. And my suspicion is that the market may well rally from here. I don't know if it's necessarily going to happen in a straight line, but maybe we start to form some sort of a base here. It's feeling that way at the moment. And this red boxed area is where I think it could potentially go in the event of a rally. That's basically a 50% rally and a 61.8% rally of the recent drop. So if we take the peak from late May into the low of now mid-June, extend that up, so take 50% of that, it gives you a move to about 46,500. If we went a little bit beyond that to a 61.8% retracement, that comes in at around about 47,200. So I won't be too surprised if we do see the market rally up into that sort of area. And then I would expect it's quite possible that we get a reversal and maybe the market starts to turn lower again. If that's the case, then I would look to probably bank the profit on this all-me future and then just leave the options to do their thing.
Yeah, okay. All right, so you're covered in all bases, it seems, locally. Yeah. Now, Garth, I know you want to discuss Bitcoin, and you mentioned to me in an email that both your mum and your sister-in-law had asked you about the merits of investing in Bitcoin. Did all the alarm bells start ringing at once?
Absolutely. I mean, this happened around about 10 days ago, approximately when the Bitcoin price was at an all-time high, and it's gone absolutely crazy over the last 2 months. There's a chart of the Bitcoin at the moment. Now, for those who don't know what Bitcoin is, it's basically a cryptocurrency. We don't have time to explain the inner workings of it, but this is the price of it. It's gone up over the last 10 weeks. It was around about $1,000 for a Bitcoin, and it was tracking that area through January, February, March. All of a sudden, it's had a huge rally during May and into June, and it's gone from $1,000 up to $3,000. So it's tripled in value in just 10 weeks. Now, this to me has all the hallmarks of a bubble written all over it. Whenever I look at my Twitter feed, I just see Bitcoin, Bitcoin, Bitcoin everywhere. When I look at Facebook, I see Bitcoin, Bitcoin, Bitcoin everywhere. Then I get a phone call from my mum asking about investing in Bitcoins, and from my sister-in-law. So all the bubble lights are flashing aggressively at this point.
So all you need now is your barber to start telling you that he's been mining Bitcoins, and then you know it's all over.
Exactly. Then we'll have the trifecta, and then you can just basically close your eyes and go short. But this was very interesting to me, and I thought it would be useful to bring this discussion to the show and have a look at other scenarios where we've seen similar situations with bubbles that have burst, and how do bubbles end and how do they start to then deflate after that. So I've got 3 examples or 3 prior illustrations of classic bubbles that have burst spectacularly in the past, and they all exhibit very similar characteristics. The reality is human psychology doesn't change. We've seen bubbles bursting all the way from the Dutch tulip mania back in the 1600s, and bubbles have come and gone since then, and they continue to come and go. So let's just look at 3 of these most recent ones.
And very recent, in fact. And I mean, that was probably the most spectacular of the last couple of years.
Yeah, this is the most recent one. So this is the Shanghai Composite in China. And back in 2015, this market just went absolutely crazy, and retail traders and investors were all over this market, and again, it had all the bubbles hallmarks, and you can see how it just went up and up and up, and it went parabolic at the end there, and then you had this almighty smack, which was in around about July or August, I think, of 2015, and then you get a rebound, but the rebound is never big enough to go and take out the prior highs, and usually that is actually the safest time to go short, right? The Shanghai Composite doubled in a space of 6 months in 2015, and you can see then it ended very badly, and it's continued to dribble lower since then. So that was one. Another one that is very famous, of course, is the NASDAQ and the tech bubble that burst in 2000. And at that stage, you can see here's a weekly graph of the NASDAQ, and it had also, in its final stages of its rally, now keep in mind it had been climbing and climbing for a number of years before this, but then it eventually hit this blow-off period where it rallied from about 2,500 up to 5,000 on the NASDAQ within 3 months.
Wow.
It pretty much doubled within a space of about 3 to 5 months, there and thereabouts. And then again, you see it had this massive big crack, a rally. The rally was insufficient to then go and take out the all-time high, and you saw a reversal down and then a further leg to the downside. Now, in my experience, shorting these types of bubble situations, if you're going to do it, the time to do it is actually on that big rebound. So don't try and short into a bubble that's busy inflating, because you just have no idea where the top is going to be. You're just guessing. But you generally do get an opportunity to initiate a short after you've seen that first big crack, like we saw there on the NASDAQ, then the rally. And that rally, the rally that is unable to take out the all-time high, that is the time that you want to go short. And you probably then can put a stop loss above the all-time high if you're going to do that. And it would have worked beautifully on the NASDAQ, and it completely collapsed from there for a number of years.
And 17 years to recover, essentially.
Exactly. It's only recently gone back past those levels now in the last year or so.
Yeah. And the Rand is the last one, very quickly before we wrap up.
The Rand dollar in 2008, now the Rand has done this a number of times. It did it in 2001, 2008, and you could say it even did it at the end of 2015 as well. The Rand has a habit of blowing out every now and again, and it did it in 2008, and you can see again the currency weakened by 50% over a 3-month period. It then hit at that stage 11 Rand 50 to the dollar, fell very sharply and had a rebound, but the rebound was unable to go and take out that prior high, and of course the currency then strengthened. In this case, the dollar weakened against the Rand thereafter. But it has all the same hallmarks. There's a big blow-off move, a sudden crack, a rally that is unable to take out the prior high, and then it drifts lower from there. So if we take this back to our Bitcoin situation, I don't need to say too much. I mean, the viewers can look at that chart and take it into context of what I've just said with the previous 3 examples, and it's up to you to decide what you think is going to happen from here. But I think we could look back in 6 months' time and this thing will probably be lower.
Well, if only our foresight was as good as our hindsight, I mean, that would, we wouldn't be here. Garth, very quickly to end off the portfolio, what's it looking like?
So our local portfolio is looking fine, up 22% for the year to date. That is taking into account a theoretical profit on our option structure at the moment. Yes. So obviously the market weakness has played nicely into our hands there. Our Sibanye trade is actually at a break-even point at the moment, so not much to say about that. Offshore, we're still not looking great. We're down 4.8% for the year to date there. We definitely need to try and get this thing back into better health, looking out for the latter half of this year.
Yeah, okay. Well, that's where we leave it. Garth, thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.